whose dog will end up on their lap first?
Not mine, mate. I can assure you of that.
Evening world, we're back. Rates and ladders on a Tuesday evening with the money man Dom, Neil, and just Dan absent again today. But we carry on, we press on. So it's good to be back. Exactly. It's good to be back, gentlemen. I know it's been a few weeks, but the world's still turning, and you're both looking well.
Just about now.
Thank you, mate. Thank you. I still think your cameras are better than mine, but then maybe it's also the 20-odd years you've got on me. But
it's all about the lighting.
Your youthful
look. It's all about the lighting, mate. Yeah.
Yeah. I'm in my dining room, so that's obviously an issue.
Cool.
Don't want any glare.
Well, so what's been going on, chaps? I mean, it's been a couple of weeks since we last spoke on here. Dom, do you want to tell people where we're at with rates roughly? I think we're more or less in the same place, aren't we? We're looking at low to mid fours for most people. Am I right in saying that, or have things changed?
No, you are right. They went through about 3 weeks ago. They sort of started to creep up again, only kind of marginally. So they sort of dipped below 4 for a little while, but didn't kind of stick around there. But I have noticed, what I will say, I've noticed in the last 48 hours, we've had quite a few alerts of rate reductions from big lenders. So I don't know if we might just see this sort of choppiness coming through. They'll sell what they want to sell and then reprice to come out of the top of the league, so to speak. But I think it's positive, and that goes across residential mortgages and later life stuff. So, people that are looking to release equity from the homes in their later years, those rates went a bit crazy. But I've noticed a bit of downward pressure there, which I think is a good sign, really. We've got all this stuff in the background about Silicon Valley Bank. Starling Bank is fine, I gather. Silicon Valley Bank, and then Credit Suisse, and talked about global contagion, and is this another financial crash, or that sort of thing. But no, the residential mortgage market is looking in good health, I have to say.
That's positive. Yeah. That sort of peaks and troughs, so to speak, of lenders just dropping rates or bringing new products in. That's fairly common, though, isn't it? In terms of just year on year, they tend to just do that as a natural thing. I don't know why is there a reason why they do that all the time?
They allocate certain amount. I mean, the bottom line is they allocate certain amounts of capital to a lending tranche. What I mean by that is they'll say, well, we've got 250 million to lend at this rate, and then once they've lent it, that's it. They'll then bring in a new tranche. So when they start to get towards the end of it, they'll kind of give 2 days notice that actually we're going to reprice, so those products are going to come off the shelf and we'll come back with something new. And it could be slightly lower, it could be a bit higher, but essentially they'll allocate blocks of capital at specific rates and then manage them on that basis. So you get some of them where they might sell out in a day. That sounds a bit weird, but it'll be priced quite aggressively and it will last a day and then it's gone, and they'll say, actually we've closed our book for today.
Reduced to clear, basically.
Yeah, or not necessarily reduced to clear, but tactical to, we've got this money at this price, we're going to lend it at this price, and once it's gone, it's gone. And it's kind of how they work. So I saw a headline earlier, I think it might have been on Twitter, that the average 5-year fix is now at a 6-month low. So they're taking the average, but it's at a 6-month low. That can't be bad news for anybody. It can't be bad news at all. No. If you think about where we were at the end of last year, it was all a bit miserable. We're now kind of landing back into something a little bit more sensible, shall we say. Long may that continue.
I think that seems to be and Matt, you'll probably say the same, that seems to be the general consensus through the market as well. So we've had our rates and now our ladders, but yeah, I'd say there's a bit more confidence in the market in itself in terms of viewers, buyers making offers and whatnot. We're still selling plenty of properties. But yeah, I was chatting to someone the other day about that. They've now had a bit more competition with open houses or competitive offers and stuff. So yeah, it seems like now the dust settled, should hopefully flourish into spring and into summer traditionally like it normally does. So
yeah, I've been pleasantly surprised, as we said in previous weeks, just at the level of activity which is going on. You know, people are just moving, and I think 4% is the new normal. As you know, Dom, I'm looking at moving later in the year, and I'm just thinking, well, 4.5% is where it's going to be. Whether that's 3.9, whether that ends up being 4.6, you know, it's not going to change my life, and I need to move. So
yeah,
I think that's the sort of pragmatic approach anyone should take when they're thinking of moving this year.
Yeah, I think it's comfortable for you in the sense to go into it with the mindset of, right, this is the new norm, so to speak. I think there's a lot of people that are in fixed mortgages that might have been tight. Now they're coming to the end and they're like, oh, that's where you'll see the struggle, I think. But yeah, I think there's that in terms of new buyers or first-time buyers that are out there actively jumping into a mortgage, it seems pretty good and confident. I'm literally looking at our diary from Saturday and Sunday. Matt, yours was just as busy as Dan and I. And I had 10 viewings on one house, 6 on another. Dan had about 16 on one house, and it looks like you had about 10 to 15 viewings yourself. So definitely busy numbers out there.
Yeah, and it's great as well how many first-time buyers are in amongst it as well. People who have saved during COVID, people who are just in the market now, ready to buy. It's brilliant.
Yeah. I actually think it might be a first-time buyers market, you know, just because you know they've built up the war chest. It's often not a want. It's it's time now. You know, it's a need. We need to, I don't know, move out of mum and dad's, or we need to get out of this rental property. And I'm getting a few inquiries from people that have been renting, and they've been renting for a while, and they've built up a decent sized deposit, and they've been kind of holding off. But you know, they can see the writing on the wall in terms of rents increasing. And I don't know if you guys have had much experience of that, but certainly rents seem to be on the rise. So it is still, I mean, it's becoming marginal. And if the rates stop where they are, I think it will probably settle down. It is cheaper to buy a house than rent one.
Yeah.
And if the pressure continues on the availability of rental properties in the absence of the government doing anything meaningful, which they won't, I mean, they'll just kick the can down the road and leave it for the next incumbents, for another problem for the next government. Some folk will have no option but to say, do you know what, we're going to have to do something. And kind of creates that first-time buyers market, particularly if you then have landlords that can't remortgage because they can't pass the stress test, or they're just fed up with it and they want to take their money. You could get, you know, properties coming on that are actually quite attractive to first-time buyers.
Yeah, I think there's quite a flurry of that. I definitely agree with you, Dom, from the people that I'm speaking to, in terms of where it's a lot more common for people just to rent for quite a few years, where they would want to move around and it's socially acceptable and whatever else. And the same with people just living at home. The age of people living at home just got older and older, didn't it, for quite a while?
Yeah.
So I think with COVID, obviously back end of that, and now back to normality, people are going, right, I do actually just want my own space. And I think the bank of mum and dad is still definitely out there, and helping a lot, especially around this area. I think Reading and its surroundings are quite affluent enough for people to be doing bank of mum and dad quite a lot. So I think, as you said, writing's on the wall with regards to the rentals. That's not changing anytime soon. It's getting tougher for people, so it makes sense for people to now just buy, which is good news for us.
It's worth me saying, on the rental side, I've been looking at existing landlords that are seeking to remortgage, and maybe haven't reviewed the rent in quite a while. And if they're higher rate taxpayers, a lot of them often are, you know, they're in the 40% bracket, which affects the stress test. 145% versus 125. That's a whole another conversation, but it's harder to pass the stress test if you're additional rate taxpayer. A lot of them, you know, they want to remortgage and they can't even remortgage what they've got currently. So it's like, right, you know, we've got some decisions to make here. You either, you know, put in some more capital, or we try and top slice on your salary, or, you know, you might have to review the rent. If you want to carry on with that property, you're going to have to, I'm afraid, examine whether you're charging market rate for the current rent. And, you know, that's just, unfortunately, that's a reality. You know, the market drives what people have to pay. But a bunch of people will just say, oh, do you know what, I've had enough. I've done. Now, that's great for people that want to buy, but for the thousands of people that are relying on renting for any number of different reasons, it's not a great picture for them at all. And I worry it's a problem that's going to get worse.
It is tricky. I think it's similar to what Matt was saying about the new norm of mortgage rates. I suppose it's the same with the rental prices. People that are delving into it that are none the wiser, that are coming from mum and dad's or for wherever else, and they're going into rentals going, oh, this is just normal to be paying 1,200, 1,300 quid for a 1 bed or a 2 bed in the area. So, but I think it's like anything, it's all relevant and relative for the people dealing with the numbers, I suppose. But
while we're on first time buyers, I've got a question for you both. Obviously, there's two parts to buying your first property, right? You've got saving the deposit and then meeting the affordability. I asked myself, which one of those is the biggest struggle? You know, Dom, you probably have a better insight on that. They're both hard, right? I still remember saving my first deposit. But it's probably a difficult question to answer.
It is a difficult question because some people have really good earning potential, or you know, or they can demonstrate good earnings, but they haven't got a big deposit, and it could just be a bit of a problem because if you've got good income, the actual amount you need to borrow isn't the problem. The fact you've got a very small deposit like 5%, which really, you know, 5% used to be okay. I don't think it is anymore because you're genuinely going to be paying a premium for the loan that you want to take out. The lender's just going to price in, you know, risk on that end. Deposits are difficult to gather. It takes time. If the market's moving against you in that time, you know, you're sort of chasing a moving target. I mean, I think broadly, everyone should try and aim for 10% where at all possible, because that's when, you know, if you get out of that 5% deposit bracket into 10%, then you're starting to play in a slightly less risky loan to value band and therefore interest rate. I think you know what I'm going to say though. It's best in these situations to work out where you are today, and if that's not enough, understand where do I need to get to, and then calculate how long it's going to take you to get there. Because I think, you know, if you are coming up short on deposit, but your affordability is fine, assuming you feel confident in your employment and, you know, the fact that that's going to sustain, you can then target ways of inflating that deposit as quickly as you can. That might involve some hard decisions in terms of how people live their lives currently versus what they might have to do in order to save more, but at least they know where they stand. And I think that's probably the advice I would give anybody in this space is find out where you are today, and based on what you want to achieve, then you'll know what your gap is if you've got one, and if you have got it, how you try and fix it. Whether that's a conversation with mum and dad or gran and granddad to see if they can, you know, offer a bit to help, or, you know, look at ways of budgeting to save a bit more. You know, there's any number of different ways you can do it.
Yeah.
But sometimes it just takes time, unfortunately.
Believe it or not, I used to believe it or not, I say, but yeah, a few years back, I used to actually be quite good with my money. I know, it's a funny one. But yeah, when I was saving for certain things, it would always be, right, whenever a wage packet comes in, ignore this section, that just disappears. You don't touch that. And I think that seems to be the general consensus for a lot of people, is how they're saving now is just having these sub folders, sub pots of just constantly saving and living off a certain amount each month, which is a good way of doing it.
Yeah. I like the point you make about the 5% mortgages, Dom, because when they became normal, it was a couple of years ago, wasn't it? 5% mortgages came back into the market. I thought, great, you only have to save half as much now to get on the property ladder. But as you rightly alluded to, you're paying a premium for that larger loan, which in most cases, the benefit of having to put less deposit down is that you just pay the bank more money.
Yeah.
So, like you say, if you can save that 10%, it really does help, doesn't it, in the longer term view?
Yeah. And it just, it really just depends, doesn't it? If your outlook is, well, I can't get from 5% to 10% for at least 3 years, but I could buy now with 5% and just swallow it,
and not rent. Yeah.
Then that might be the right answer. And I've done probably a handful of those in the last 6 months where the client just did that. They did decide that was worth doing. They'd seen the house, they liked it, and they said, what, rather than flush X thousand down the pan over that time whilst we try and chase a bit more, we're just going to bite the bullet. And that's also okay. It's all about personal choice, isn't it, really? But 10%, I think, is you get to 10% and you should be cooking generally.
Yeah. And there's not a huge difference in the rates, is there, at the moment? Oh no, there is. Sorry, my memory's played
there
me
is,
there. It's 0.5% or so.
Last time I looked at 95 versus 90, it was about 0.8. So it was getting on for 1% difference for the extra 5%. But when you start to drift down from 90 to 85 to 80, that it's pretty bunched up. In some cases, there's no difference between 85 and 80. It's one of those where
because we compare the 90% loan to value to the 60%. I just look at those figures when they come in every week, and it seems like
you'll generally see a much starker difference between 60 and 90, because that's quite a big gap. But if you come down in 5% chunks, it's not that. It doesn't make that much difference, because in some ways, somebody that has some optionality around how much they put down will look at it and say, well, you could put down X, but that only gets you 30 bips on the rate, which actually isn't, you're not going to get that back over the period. So you might just decide to keep that money, have it as an emergency fund, use it to, I don't know, new carpets, decorate, whatever it is, to personalise the house, rather than, try and chase the lowest possible rate you can if that's not right for you. So everything comes down to sort of individuals and what it is that they want to achieve and what they want to afford, really.
Yeah, makes sense.
Circumstances, like anything, makes sense.
100%.
Cool.
We've had a little question come in from Mr. Mac, but
what's he saying?
So looks like 3-year deals are improving.
Yeah, we haven't covered that, Ian. I think that's true. That if you look at the swap rates, they have been trending down over the last week or so. So there are some deals to be had if you want something of a slightly shorter duration. The conversation I'm having most with clients right now is, should I fix for 5? Because what if it gets much better again in 2 years' time and I'm stuck with the 5-year rate? And I sympathise. I genuinely do, because that is a real risk with what's happening with the central banks. And we talked a little bit about these sort of bank failures and, oh my God, it's liquidity problems and all that type of stuff. I think that my feelings around the increases to the base rate when the governor of the Bank of England said they weren't in charge of 85% of the causes of inflation. I just didn't think the patient needed the amount of medicine that he was being given. So the potential exists that they'll start to throttle back on that at some stage. I'm not saying it will. I'm just saying my perception is that probably it will get better. But it depends on your appetite. If you don't want to keep looking at your mortgage every 2 years because you're you're trying to chase something better, sometimes it's better to just get the best deal you can at 5 years and forget it. Especially if there's a fee involved every time. If there's a lender fee of 995 and you can't pay it, so you add it to the loan, it kind of is, you're sort of, I don't know. You can never time the market, and sometimes it's in your favour and sometimes it isn't. You've just got to make the best choice for you at the time, and accept that sometimes you'll get it. You'll get lucky, and other times you won't. Just make the best judgment that you can, really. But it's a horrible conversation because I don't know. I've got an opinion, but I don't know what's going to happen. So I can sometimes say, this is what I would do, but my appetite for risk is going to be different to yours. Is going to be different to yours. So it's a tough one. It's a very tough one.
Yeah, interesting.
Yeah.
Interesting.
Yeah.
I think I look at it because I'm in a 5-year fix at the minute, and I'm like, oh. So yeah, it's an interesting one to look at, and I'm sure I'll be looking at it closely in the next 12 months.
Yeah,
because I got a 5-year in May 2020. So of course, in May 2022, I was thinking, oh God, I should have got a 2-year because it would have gone from 2.2 to under 2%. But it's not a big deal, and then I'd have had to pay a fee, and do you know what I mean? Once you actually. I was like, actually, I'm no worse off really by doing the 5-year versus the 2-year.
Yeah. I think the grand scheme of it is it's a bit like buying and selling at the right time. You don't know that's going to go like that financially. So it's the same sort of thing, isn't it?
Yeah, exactly. So I hope we've given a bit of optimism to the first time buyer crowd who might be watching this.
Yeah, I think it's good. It's definitely positive out there from the viewings that I'm dealing with. There's a lot of first-time buyers out there. There's a lot of activity, and it seems dust has settled, so it's good. Yeah,
I've seen I suppose my closing thought on this is I've seen a bit of chatter and a bit of media reporting about it's really hard to get a mortgage, and lenders are being really cautious and really hard to get them to say yes. Rubbish. You just got to know where to go with it and how to present it. I've had no problems this year at all, regardless of each individual circumstance. It's about understanding which lender is the best fit, presenting it in the best light, getting the underwriter to say yes. No problem. So anybody that says it's getting harder is probably either using the wrong person or trying to do it themselves. And my feelings on that subject. It's just in a market where it is very volatile and things are up and down, you're better off just giving it to somebody that's doing it every day, because we'll just cut through the.
That's pretty much my number one question when I'm registering a buyer for their search is, are you dealing with a broker or are you dealing with direct? And they'll always question it, and I'll say it's just brokers are worth their weight in gold at the moment. I'd say all the time, aren't they, Dom? But currently, even more so.
Especially now.
Exactly.
I think so. Nice.
And just as a closing thought, if any first-time buyers are making offers on properties, having a broker who you can put in touch with the agent makes a huge difference. I know you're the same, Neil. If you know there's a broker on the phone as soon as someone's made an offer verifying that buyer's position, all of a sudden the credibility of that offer increases significantly.
Yeah, I think I probably touched on it on one of our previous chats, but I had I think 4 or 5 offers on a property, and the 2 or 3 highest offers, two of the brokers came back to me nice and quick with information, and one of them didn't, and unfortunately that person didn't get the house because their broker couldn't qualify them, or I couldn't qualify them. So make sure you've got a broker to hand, and make sure they know you're out actively looking. Nice. Cool. Happy days.
With that, I think we will close and maybe come back next Tuesday if you're both around. How's that sound?
I think we ought to try and be a bit more what's the word? Consistent. Great word. Consistent. I love consistency. I love it.
Yeah. We might well have Dan back with us too. So yeah. We'll see.
I'm definitely around next week. It's in my diary already. I can look at it right now.
see you on Tuesday.
You worded
Nice
that
one.
right.
I did specifically.
All right, guys.
Nice one. Cheers, gents.
Peace.